Good morning, I'm Donnie DeLange and I'm going to take you through the main highlights of Barclays Africa's year-end results. The share is trading at a PE ratio of 11.1 times and 1.8 times its net asset value, and we believe the recent re-rating of the share fairly reflects the improved expectations for the business. However, we feel there is still an upside earnings risk to the current market expectations should structural economic reforms be achieved. Despite the narrowing of valuation differentials, the share still trades at a discount to the market, which we believe is justified given the unique risks to the business. There is renewed confidence in the domestic economy, and this should provide a more conducive environment for banks through both lending and transactional activities. Therefore, we should see improvements in the ROE on the medium term, as cost controls will likely remain a focus. Competitiveness in the South African retail business remains a concern, although the stronger performance in the second half of the year is encouraging. The retail base should be impacted by new competition coming into the market. Despite providing a unique opportunity to replace older infrastructure through the separation, the potential for complications in the process is an additional risk. Barclays also has a solid forward dividend yield of 5.5%. Just highlighting some key financial points of the results, their net interest income came in 1% higher for the year. Loans and advances were up 4% with broad-based growth across the business. The average interest-bearing assets was up 1%, and their net interest margin was stable at 4.95%, weighed down by a higher contribution of corporate loans and the impact of the NCA interest rate caps in the unsecured portfolios. Then their credit loss ratio dropped to 0.87%, coming off a high base in 2016 due to large specific corporate exposures. Then their non-interest revenue, which makes up 42% of total income, increased by 1%. This was mainly on the back of fees and commissions that grew by 5% and was partly offset by trading income in the corporate business, which dropped by 11%. Next, the cost-to-income ratio deteriorated to 56.8% due to slow revenue growth, while the group continued to invest in sales capacity and technology. Diluted headline earnings per share of 1,838 cents was 4% higher on the back of lower credit impairments, with pre-provisioning profits down 3% for the year. The final dividend was increased in line with earnings by 4%. Now looking at their prospects, management provided the following guidance. They expect improved loan and deposit growth with faster growth in corporate and the rest of Africa. They expect a slight decline in net interest margin, strict cost containment leading to an improved cost-to-income ratio. They also expect a stable credit loss ratio and a ROE marginally ahead of the previous year. With the new growth strategy, management plans to achieve double-digit growth and double their share in the rest of Africa from 6 to 12%. However, no clear timelines have been set out for this new strategy. Lastly, looking at the portfolio guidance, Barclays has a capped Swix weighting of 2.45%, and we believe the share is fairly valued at current levels. We recommend a neutral position in the share with a recommended exposure of up to 3.47% compared to a previously communicated overweight guidance. Before I end off, if you wish to place a trade, please contact the trading desk. Investors are reminded that they can refer to the research tab on the PSG Wealth trading platform to view the more in-depth company analysis. And please look out for our next trade idea on the group, which should follow the release of its half-year results towards the end of July. And investors can also refer to the filter tab under the research section for the PSG Wealth trading platform for a live relative valuation on the group in the interim. And also please note the following disclaimer. You can find a video on the website under the video tutorials tab titled How Do I Interpret a Trade Idea to get a better understanding of our portfolio guidance matrix for investors that want a deeper understanding of our valuation process. Thank you very much and enjoy the rest of your day.